Hi everyone, welcome to Option Strategies. In this video, I want to talk about how I plan to trade crude oil with option. Oil price has started to increase since the beginning of 2022 and then start to drop after reaching the high on June. Now the price is at about 50% retracement from June high. The price is extremely volatile with the international incidents. There are many products that can be used to trading oil. Here are a few of them. First, United States Oil Fund with ticker symbol USO, which invests in oil future contracts that are traded on regulated future exchanges, and its performance is determined by the price of oil through its oil future contracts. Next is Energy Select Sector XPDR Fund with ticker symbol SLE, which comprise of companies that primarily develop and produce crude oil and natural gas and provide drilling and other energy-related services. Next is SPDR S&P Oil and Gas Exploration and Production ETF with ticker symbol XOP, which track an equal-weighted index of companies in the US oil and gas exploration and production space. Last but not least is VanEck Oil Services ETF with ticker symbol OIH. The ETF tracks the overall performance of United States listed company involved in oil services to the upstream oil sector, which include oil equipment, oil services, or oil drilling. In this video, I'll choose to trade USO, which is the ETF that closely related to the crude oil price. This is the chart of USO as of August 15, 2022. The chart shows that USO price started to increase at the beginning of the year. Then it gets volatile with high bid up and bid down since March. It reaches high of $92 about mid-June and then start to decline. So how I can trade crude oil at this point? The first option strategy that I plan to use is long straddle, which is set up by buying one at the money put option and buying one at the money call option with the same strike price and same expiration. This is a profit or loss profile of long straddle strategy. In this trade, I choose the short-term option to minimize the risk by not paying too much for time, because time is one of the components that affecting option price. The longer the option contract lasts, the more premium I have to pay. This strategy requires USO price move more than the premium that I pay either up or down, which means I do not need to predict the direction movement of the ETF price. I just need the USO price to move more than the premium that I pay. Another benefit of this strategy is unlimited profit. If anything happens and the oil price spike or collapse, I will be able to make huge profit from the price movement. Meanwhile, the risk is limited to the premium that I paid, which means I will not lose more than the premium that I paid. To further minimize the risk, I can use an option strategy called short call butterfly. To understand how this strategy is set up, let's look at the profit or loss profile of the strategy. Short call butterfly is set up by buying two at the money call option with the same strike price, then sell one out of the money call option, and then sell one in the money call option. Short call butterfly is very similar to long straddle strategy. It also requires USO price to have a big move, either up or down, to make profit. The strategy also has limited risk, but unfortunately, because of the calls that I sell to reduce the risk, my maximum profit is limited to the premium that I collect. Thank you for watching, and remember, all trades discussed in this video are not trade recommendation.